Coto. Many of you know him. He is a diamond partner and supporter of our network this year. Frank and I have been working together, probably 6 or 7 years now. I'm not really sure. It could be longer. I've helped him buy property. I've helped him sell property. He's financed my mortgage and refinanced my mortgage. So not only have we become good friends, but he is also someone I've had the pleasure of actually working with their company as well as our clients working with them. And so what I wanted to do is kick it off today, Frank, first with tell us 3 things we might not know about you, or give us a little insight to Frank Coto, the man, the myth, the mystery.
God, thank you, Cindy. Great introduction. Wow, 3 things. I talk so much. I don't know if there's anything people don't know about me. I am born and raised 4th generation from Tampa. Some people may not know that. We are few and far between over here. Let me see what else here. I like hunting. I'm an avid hunter. And during COVID, I bought a farm up in North Florida, which I never thought I'd ever become a farmer. So that's a lot of fun. Everybody thinks I'm a crazy city boy. Gosh, what else? What's the 3rd thing that people don't know about me? I don't know. I'm a Florida State guy. Maybe I didn't used to. I used to say it all the time, but I don't anymore because we're not that good. So I guess I'm just a Florida boy all around. If you didn't know me, now you know. And I like being in the woods as much as I like being in my office.
That's so true. I know that about you. And you have 2 beautiful kids and an amazing wife, Nicole, who's an appraiser. So it's a deadly combo of just lots of wealth of knowledge. And I'll also tell you guys a little sneak peek, but Frank talked about his farm up in Tallahassee. We talked about maybe doing a women's council retreat up there because it's a big farm. So
yes.
Anyway, that might be a fun way to see it. So one of the things we wanted to talk about today, Frank, was I saw where the government has put some new fees on different mortgages going forward April 1st. So tell us a little bit about what we need to know for our buyers, what that's going to look like. Are there ways to minimize those fees? Just share a little bit about what you're seeing on that.
Yeah. So thank you, Cindy. So the fees you're talking about are called LLPAs, loan level price adjusters. If you don't know how pricing is done in mortgages, when your client is given an interest rate, or when we look at a rate sheet, let's make it easier. That rate sheet might show interest rates from 3 to 4%. And all of them are available to your client. But as we know previously, they would have an adjustment. If you qualify for what's called the par rate. The par rate means the rate doesn't pay me anything and it doesn't cost your client anything. Let's say that's 3.5% today, right? And then you type in, it's going to be a second home. That's what it's really, the focus is what it's really going to affect is going to be second home buying, which is huge, obviously, for us in the Gulf Coast over here. There used to be very small adjustments to the interest rate when you decide to buy a second home. For example, if 3.5% is par, and you having nothing to do with second home, just a regular loan, maybe your client wants to have 3%. Well, maybe he had to pay a point, okay, to get to 3%. And then the lender would have to charge something on top of that if they want to make any money because the rate's not paying anything. Well, now with these new loan level price adjustments, depending on your loan to value, okay, how much money your client's putting down compared to the purchase price, there's going to be major adjustments. For example, we could go to as little as 10% down. Conventional lets you go 10% down on a second home purchase. Well, previously, the loan level price adjustment for 10% down would be a quarter, maybe 3/4, depending on credit score. So what that would mean is it's not that the rate changes by a quarter or 3/4, the cost of the rate changes. So now with these increased loan level price adjustments, 10% down carries an adjustment of almost 4%. Okay. That's insanity. Number one, it's not going to be, it's not sustainable with the way the rate sheets are built right now and the way the rates are offered, because most of the time, the highest yield on any rate in our industry given by Fannie Mae is about 4%. Now, we kids brokers can't even make 4%. Your maximum is 2.75% and 3%, when you get to the high cost. But you don't ever see anybody set over 2.75. So this adjustment of 4 is a major deal because It literally means at the same rate today on April 1st, and it's really before April 1st, everybody's implementing it now because the loans have to be sold to Fannie by April 1st. It changes that day. So in reality, all the lenders are implementing this pretty much right now. I have the ability to close up until March 10th without this affecting your loan pricing. But that same rate today that cost a quarter, let's say, is now going to cost 4.25. So what does that mean? It essentially means you can't even get that person that interest rate. You're gonna be crossing all the limits on high costs. So what do we do? What are our solutions? Well, right now, just like they had some crazy stuff happen with cash out refinances during COVID. If everyone remembers, we had the same news come out saying that there's going to be LLPAs on cash out refis, and it was a 0.5 point hit across the board. They did remove that. So we're hoping that as this thing flows down the chain, it will get removed, but let's pretend it doesn't. How do we get around it? First way, if your client wants a conventional loan, is they're gonna have to put down more money. The LLPAs decline with your down payment. So your minimum down payment is 10%, 15%, I believe the adjustment's about 3%, 20%, it drops down to 1.5%, 25%, it gets back to normal. So what do we think in the behind the scenes? We think that they're doing this not because they don't want to do second home loans. We think that they want people to have more skin in the game on second homes. That seems to be the only reason that Fannie Mae would be doing this, is they're trying to force second home buyers to put more money down. The solution that we've come up with immediately is using non-QM loans. Non-QM loans basically, it's still a bank. It just means it's not Fannie Mae or Freddie Mac. It's not a conventional loan. It is a non-qualified mortgage. And what we have found is their interest rates on a full doc comparable loan like you give to a Fannie Mae lender, they're actually better. Believe it or not, they're better than conventional, and it's never been that way. Usually very rare that you would take a buyer who can prove all their income and assets over to a non-QM lender. We would normally use that for bank statements or no income verification or stated or some foreign national, condo, hotel, whatever other reason we would use those types of loans. We're finding that we can compete. So the good news is we now have a product available that your clients, and everybody should who has non-QM, has a product that you can still put down 10% and you're not going to be in crazy town. Now you're still going to be worse than you are today when this all goes through in the next couple of weeks. You still will be worse, but you have two choices: more money down, or we look into non-QM financing and you can still put your 10% down. But that's the biggest change.
So let me ask you a question. When you go with the non-QM financing, are the terms the same? I mean, is it a 30-year fixed, or is it more like a portfolio? Can you talk about that?
Yeah. So non-QM does, thank you. It has a lot of options. We can still do 30-year fixed. There's no prepayment penalties. Essentially, we can mimic the Fannie Mae loan. Very little difference. I would even say that they're a little bit looser. Where Fannie Mae, you run through DU, desktop underwriter, and you have to get that blessing by desktop underwriter, the approval, in order to move forward with your loan. With non-QM, there is not desktop underwriter. So in a way, it's a little better. There's a human being looking at the loan, not a computer making all the decisions. And they can go to higher debt ratios. Sometimes they can do more outside the box properties. But if all is equal, your exact, perfect loan, you're probably looking at an interest rate about 0.5 point higher. So it's not terrible. When you really put down the math on paper, maybe 0.5 point. I will say the other thing that is not great for anybody when you go non-QM is that you can't just, as a broker or banker, you can't just manipulate the interest rate by 1/8 or 1/4 to, for instance, make a point or something like that on the loan. Because, myself and I know those other companies out there, we don't like charging people on the front, meaning we don't like hitting you guys with underwriting fees and discount fees and stuff like that for the buyers. So we would just manipulate the rate a little bit to cover that, and we'd make our point behind the scenes and save the client money. With non-QM, the general rule of thumb is it's 0.5 point for every point in yield, which means we'd have to raise the rate on somebody 0.5 point to make 1 point, or raise it 1 point to make 2 points, which is about your average commission on a brokered deal. So the rates will be a little bit higher. The cost will be a little bit higher, but good news is we have the options.
So basically, if we do have someone that's looking at a second home or now these points are not just second homes, right? I mean, anything that's not your primary,
right,
they're going to be looking at that change. Is that correct?
Investment as well. That is absolutely
Yeah,
correct.
I thought so.
The reason that that you're not hearing about investment so much out there, even though what Cindy said is 100% accurate, these adjustments are for anything that's not primary. So any second home investment is because most people are putting down 20%, 25% on investments already. So you're not, the impact is not the same. Because you're
Right.
already at that loan to value. Most people don't take advantage of. In fact, Fannie Mae can do 15% down on investment. I don't think I've ever seen a client do it in 20 years. Everybody just goes 20 because you're not going to, pay PMI, which is going to be through the roof at 15% down on an investment property.
Okay, great. And then talk a little bit about the impact on jumbo mortgages, because I think you were talking about there's some impact to them as well, right?
Yeah, jumbo mortgages, they are being affected by this. The good news is very interesting that even though this is happening, a lot of lenders who previously were not in the jumbo realm are coming into the jumbo realm. So competition is actually helping that. We thought it was going to be really bad on jumbo. It isn't. It's not as bad as we thought. So the worst really is on second homes. But jumbo, for example, Home Point Financial, which is the second largest wholesale lender in America, they jumped into the jumbo space last month. United Wholesale Mortgage, they're usually number one, number two with them. They created another jumbo product to offset this. What they're doing now is a better product that you can do no PMI with only 10% down on a jumbo loan. I think that's up to $2 million. So that's really strong. So what they basically did was they took something that you'd have to pay something on and then created something you didn't. So it kind of offsets each other. So don't be too scared in the jumbo. I'm actually, I feel very good about jumbo because of the competition in the market right now. So we're going to see, and we're even seeing talk of a 5% down jumbo product. So
Wow.
right. So you take the cost, okay, I've got to pay a point or something like that to get the jumbo deal now, but I can put 5% less down and not pay PMI. I think most of our clients would like that.
Get more information. Melissa, do you have a question?
You kind of already went where I was thinking this might go with the jumbo loans, that they're trying to find a way to, obviously they're going to lose, but they could potentially lose business on the second home market. Are they going to try to is there a way that they can pass on, fees or make up the difference from whatever they were losing on second homes with primary homes? So are we going to maybe see some sort of fee raise, or is there a way that they can move the profit, like figure out a way to make the profit that way? And then the second question is, it sounded when you were first talking about this, that this could go away, that if people see that it's a problem, that it could go away. What happens to the people who are currently being impacted and closing deals if this does go away? Do they have to refinance? Like how can they kind of fix what was wrong on a loan that they already closed?
Yeah, great questions. So the first one, will we see them try to make the money on the primary market? Probably not. They could for sure, but those loans they're all sold in the secondary market. They're sold in buckets, and generally you're not buying a primary bucket with a secondary or with an investment bucket. So the behind the scenes, it can happen. Don't get me wrong, but behind the scenes, it usually doesn't. It's separated. So the good news is primary will stay strong. We don't see any changes to primary. There's been nothing on any of the talks, any of the information we're reading. I think primary is going to be good. I will say though, just since you're talking about rates and talking about primary, there is a lot of talk about where the rates are and them going up. If you've noticed any clients that were shopping over 30 days ago and shopping in the last 30 days, there's a significant difference. High twos to mid threes. And if you don't know that conventional compared to FHA and VA, conventional loans are very credit driven. So the adjustments are way bigger on those loans. So a guy with a 620, although he can qualify conventionally, it's tough to get through that DU. Remember that computer I was talking about? If he does make it through, we're seeing rates over 4% on conventional loans. So, the days when I used to talk and say, hey guys, when we go from 3 to 4, that's a 25% increase. Watch out, because that lowers what your buyer can afford by 25%. It's here. It's actually happening. The guys with the 740 credit scores, they're not being impacted as much. But that's why I think it'd be a good time for me to mention to all the agents on the phone is that conventional versus government. There is this stigma still that taking an FHA offer or taking a VA offer is a bad thing, that it's looked at tougher. guys, it's the better loan choice for your clients now, because FHA and VA don't adjust the people's rate every 20 points in the credit score. You can go from a 620 to a 700 and have basically the same rate for FHA and VA. So that client that can't afford that 4% rate, or let's say just doesn't want to pay it, why should he? When he can get a 3% rate and we don't have to charge him for it. So what I want to tell everybody is, when it comes to FHA, VA versus conventional, there shouldn't really be a stigma, except for the thing about the value sticking with the house. But in this market, I don't think that matters. There's so few houses for the buyers. You're going to get another buyer. The other thing is, everybody worries about appraisals. It's not different. Okay. It's safety issues. If there's a safety issue on a house, conventional appraisers picking it up. It's same as an FHA or VA. The one thing I would tell you is VA is probably your best loan option, because you do have Tidewater. You do have the VA appraiser does have to call you when there's an appraisal issue and give you a chance to send in comparables. No other loan product does that and gives us that opportunity. Plus, the VA is one of the best performing loans on the market, with the lowest cost and the lowest interest rate. And most people don't know this. There is no no DTI limit on VA. Whatever the VA underwriter is willing to do for the veteran, we can do. We did a 64% debt ratio, 100% VA loan last year. And I'll tell you, my vice president who works for me, he didn't even want to run it through the system. He didn't think it'd work. And I said, man, this guy's got assets. He hasn't been on his job a long time. I said, I'm willing to bet this thing approves. And it approved. And most of us didn't even think it would. So it opens up more doors for your buyers to be able to go. Even FHA doesn't really have a DTI limit. The other thing, FHA and VA don't have minimum credit scores. I just gave away my trivia question, but they don't have minimum credit scores. So not that we want to work with guys with 480 credit, but those are the people who give us the most referrals, are the people that dreams, we're making dreams happen instead of people who feel entitled to get something. So I know I deviated a little bit.
No, that's good stuff. And unfortunately, we're coming up on the end of our half hour together, but I think everybody here, and as we share it to our site, will feel comfortable reaching out to you about each of these things as they change. I know you also had an update that the what's needed with your self-employed also has improved and dropped requirements. So there's lots of good stuff happening, but one of the reasons that I love working with you so much is just the fact that you're on top of this stuff. You have a whole, range of options for people, so that I know if people are committed to getting a house, I've never had a situation where you can't make that dream come true. So thank you for supporting Women's Council, for bringing us good information, and for making yourself accessible to our members when they have questions and need advice. So thank you, Frank Coto.